Happy Friday, everyone. Sorry it's been a few weeks since we've done this, but this is Finance Friday. If you've never joined us, this is the show where we give you information you need to help you grow and protect your wealth. I am Amy Novakovich. I'm a certified financial planner and a chartered retirement planning counselor and CEO of Nova Wealth Management. Check out our Facebook page, check out our YouTube, like us, follow us, all the fun stuff. We're always putting out good information to help educate you and give you the information that you can need to either proceed, again, with finding a financial advisor or just trying to do it on your own. But Google can be a nasty place. I don't want to call it Google. Search engines can be a really difficult place to get information, especially right now with all the banks, all the headlines with all the banks. So we have been getting a lot of calls this week about the safety of banks and about if people should be pulling their money out and what we should be doing next. So I know we put out a little post saying, hey, what do you want to talk about? We had some people want to talk about investments, stocks, 529 planning. I do have a lot of videos and resources. I've actually done a Finance Friday on college planning. So if you just go back through our Facebook page, there's probably 2 or 3 on those topics that you can find. But today, again, because SVB or Silicon Valley Bank filed actual bankruptcy today. So I felt like this would be a good day to address what is going on and what can we do. So does FDIC step in and bail out a bank every time? The answer is no. But the government did seem to step in and say they wanted to help Silicon Valley Bank. The problem is I had it written down here, 97% of Silicon Valley Bank deposits were above and beyond the threshold. If you're not familiar with the FDIC, that's insurance protection on bank deposits. Over $250,000 per person. So if you have a joint bank account, you are insured up to $500,000. If you have a joint bank account with a beneficiary on there, you are insured up to $750,000. So this is per Social Security number. Now, does FDIC just cut you a check instantly? Do you think the government does anything that way? They actually have in their brochure, they have up to 99 years to pay you back. Now, do they typically do that? No. But in the savings and loan crisis in the 80s, they did take a decade or sometimes 2 to pay people back over time because there was so many that went under. So they do have a right, they do reserve the right to do that. Again, is it common? No, but with, I think it was Ironstone, another California bank, happens to be another California bank. Ironstone, is that right? That was in 2008. That was like one of the first ones that started to go under. They did set up a payment plan for that as well. And it wasn't 99 years, but they can take time to pay you back. So it's not the end all be all. Now, does that mean you should run out and throw all your money under your mattress? Also no. So I guess I'm trying to educate, but also calm panic that what happened yesterday with First Republic Bank was actually 11 big banks, I think. Yes, 11 big banks stepped in to help give them money. So it wasn't actually taxpayer dollars. Well, you have to ask yourself, why are other banks in the banking system stepping in to bail out regional banks? Now, they all say they are all important in the banking system. They borrow from each other overnight to meet their minimum cash requirements that they have to have. So they do have a little bit of a vested interest. So what happened was Wells Fargo, JP Morgan, Citigroup, Bank of America all said they're going to put in $5 billion into First Republic Bank. So that is not FDIC and that is not taxpayer dollars. Unless you can make the argument that all the banks got taxpayer dollars in the bailout of 2009. So maybe it is taxpayer dollars. I don't know. I guess it's however you want to look at that. But Morgan Stanley, Goldman Sachs, Morgan Stanley and Goldman Sachs said they will put in $2.5 billion, and then an additional $5 billion will come in a combination of another 5 banks. So we have now had Signature Bank collapse, Silicon Valley Bank collapse. We have also in the headlines today is First Republic Bank, and then of course Credit Suisse, which has been struggling for at least a year before this. So Credit Suisse really is separate. I know it seems like it's all right now. The rising interest rates didn't help these banks. However, Credit Suisse was struggling before that. So I wouldn't put them into that category. So you could look at this two ways. You could say, all right, well, Wells Fargo, Morgan Stanley, no, not Morgan Stanley, JP Morgan, Chase, Citigroup, and Bank of America are strong enough that they can just hand over $5 billion. And their bank stocks have been hammered lately, so maybe we should buy them. You could look at that. You could say, wow, that's a little aggressive right now because what other banks are going to start to go under, and I'm not ready to buy that yet. It just kind of depends on your risk tolerance and your time frame. How long do you have to recover the money? But there may, depending on your strategy, be some opportunities here. All the regional banks have also been hit very hard this week and last week. So I would take a look at some of those opportunities. Again, though, when a run on a bank happens, it happens fast. I mean, SVB, Silicon Valley Bank, went from roughly $216 billion to about $30 billion in like 2 days because there's a run on the bank, right? So sometimes it happens very fast to where you can't catch up. So that's the worry with First Republic Bank right now, is that their stock, like, let's see, where did that go? Their stock, like, last week was 120, and today they're at 25. So there's a huge drop in the stock. Again, these bigger banks are stepping in to bail them out, but what does that mean for you if you have deposits there? So first of all, I would inquire on FDIC insurance just because the government is incented to keep the banking system healthy. And they want depositors to get their money back. They don't want a run on the bank. So they want you to feel comfortable. So again, make sure the titling of your accounts have enough Social Security numbers on there. Again, if you're just joining, a joint account is 2, obviously, and then a beneficiary would be a 3rd. That's $750,000 of insurance. If you have more than that in CDs, things like that, all the like titles. So if you have 2 joint accounts, that's still $500,000 total. It's not like you can just open up another account. If the titling is the same, the insurance is the same. It carries over amongst all those accounts titled that way. So if I've got 3 joint accounts, it's still $500,000 because there's 2 Social Security numbers. All right, let's see. And so I feel like that's the first step that you should do, is just go check your FDIC insurance. I don't believe you should go run and put your money under the mattress, and I don't believe you should go run and cash in all your money and go buy all gold. So I don't think that this is one of those times. The other larger banks are very healthy. First of all, something you need to know about Silicon Valley Bank is that they were involved with a lot of tech startups. They are in Silicon Valley, California. So was First Republic Bank. They were involved in a lot of tech startups and venture capitalism, which, if you're not familiar with venture capitalism, is kind of a riskier investment structure where you invest in startup businesses that need capital. They're raising funds, and you just kind of see if it takes off. You know, you see if it can be something that hits it big or goes bust. So when a bank invests in those types of companies, they're taking a big risk. So when interest rates rose, a lot of these companies live on loans, and if their costs of these loans go up, that makes sense, right? All of a sudden they start to struggle, they start to pull out their deposits, right? The bank starts to struggle because their deposits are going down. They publish their financials, everybody goes, oh my gosh, wow, their financials have really gone down, their deposits have gone down. Then more people pull out the deposits, then they get in the headlines, then more people pull out the deposits. It's like this snowball effect. And then you're left with, again, like I said, 97% of the deposits at SVB Bank were not FDIC insured. 90% at Signature Bank were not FDIC insured. Only 61% at First Republic Bank are not FDIC insured. So I would certainly go out and just see your FDIC insurance, and then I would take a look at your portfolio if you're not having a bunch of cash at any of these banks. I would look and see if any of these are opportunities. Again, this is not a recommendation because those are going to be really risky. Tomorrow that stock could go down 70%, but you also could be buying something on sale. So it's called a speculative investment, meaning there's really not enough analysis and research in the world that you can do to predict what will or will not happen in the short term. So it's speculative. You're taking a risk at buying and hoping that the bank will double. Like First Republic, when it got the news yesterday, I think that was yesterday, when they were getting $30 billion. I'm shedding here. My hair's coming out. $30 billion, all of a sudden the stock went from down 18% to up 10%. So it was this huge swing. So if you are a day trader, again, super aggressive, and this is not a recommendation, we do not day trade here. But you're probably having a heyday, right? Buy and sell and buy and sell. And it's going up and down and up and down. It's down to $25. It's down 20% today. So these banks are really fluctuating. So it's not something, if you need the money in a year or 6 months, it's not something you want. So you have to look at your time frame. How long do you have before you need this money? It needs to be longer term because you need some time for all this to shake out. I will say, the gentleman who was in The Big Short, if you ever saw the movie The Big Short, there was a gentleman in 2008 that shorted, meaning bet against the housing market, made a bundle of money, ton of money. He is now saying that this is similar to a time in 1907 when we had a few banks fail, and the bigger banks, actually it was JP Morgan, stepped in to bail them out, and then the market hit a bottom very shortly after that. Within 3 weeks, the market rebounded. So I would just highly recommend that you don't just always just feel a sense of panic when you see headlines like this. Sometimes you just have to sift through the information and see how it can benefit you. And that's the smart, calm, cool, collected head that you need when investing. And if you can't be that, then you need somebody to help manage those emotions, right? So that's when you would call a financial advisor, your current advisor. You'd call a firm like ours. And if you do have questions, feel free to reach out to us, but it's info@novawealthmanagement.com if you do have questions. But I would certainly reach out and just see if something like this makes sense for you, but it is presenting a lot of opportunities. So some people have always have also been asking me, so we talked about the FDIC, we talked about the details of the run on the bank, we talked about the bailout, but Silicon Valley Bank and Signature Bank and First Republic Bank, again, I just want to stress, wasn't just your typical everyday consumer bank. So should you go down to Wells Fargo and pull out all your money? No, I don't believe that. I really believe that those banks are fine and you should leave your deposits. Go ahead and check if you're FDIC insured, but I don't feel like this is something that should stress you out. They're the ones that are stepping in to bail out other banks, so I certainly would not feel that they are at risk right now. So hopefully that calms some nerves. Hopefully that educates a little bit on FDIC and how a run on the banks work. And some banks aren't even publicly traded, meaning they're not a stock. So FRC is the ticker for First Republic Bank. They are publicly traded. It goes up and down. But some banks, they're not in the limelight. They're not in the headlines, and then there's a run on the stock. It can be really hard for these banks once they're in the headlines to stay afloat. So I would worry about like an FRC, like a First Republic Bank. If you've got money there, I would be a slightly bit concerned. They were a $212 billion bank in 2021. As of 2022 end, they were at 170-ish billion. And then now they're about 70 and they're getting $30 billion and they're still getting crushed today. So I would be a little concerned there, but with the big boys, I would really not. So hopefully that answers some questions. If I missed something, again, please feel free to comment below and I'll answer it later, or shoot us an email at info@novawealthmanagement.com. All right, we're already at 14 minutes. It goes just like that. All right, I hope you guys have an amazing weekend. Have a great St. Patrick's Day. Say St. Patrick's Day. Have a great St. Patrick's Day. And again, if you have any questions, please feel free to reach out. All right, we will see you. Oh, I'm going to try to get my daughter Hope. I don't know if you guys have seen the little videos that I used to do with her when she was little on Finance Friday. Or no, I did it. Well, we didn't do it Finance Friday, but we did little clips with her. She's now 8, so I'm going to try to get her in here next week since it's spring break, and hopefully we'll have a little special edition with her on finance and what she knows. All right, guys, have an amazing weekend, and we will see you next time. Bye.